Hi everyone. The last topic that we'll cover in this course is called assets and mortgage-backed securities, and we will see all kinds of sophisticated financial instruments that also belong to the realm of fixed income. They become very popular, very known in the early 2000s. And then, as you probably heard, those kinds of toxic assets also led to the recent financial crisis in 2007, 2008, 2009 that also glitched into 2010 and on. But in any event, those are very, very interesting fixed income securities that we would like to know something about them. So what are we going to cover in this topic? You will see an introduction to this topic, development of the market, special purpose vehicle, what does it mean, credit enhancement mechanisms, and then we'll delve into three things that are called collateralized debt obligation in general, asset-backed securities, and mortgage-backed securities, and finally we will summarize. Okay. A little bit introduction. So mortgage-backed securities, and there are a lot of synonyms here. So I will use the MBS for mortgage-backed securities, and asset-backed securities that are shortened to ABS. They constitute the largest sector of the bond market. Surprisingly, as it may sound, they are much, much bigger than all the other bonds that markets that we already talked about. In the US, for example, the term mortgage-backed security is used to refer to securities backed by residential mortgage loans, while asset-backed securities denote securities collateralized by other types of consumer loans, such as car loans. We will see a little bit more on that later on. Mortgage-backed securities and asset-backed securities are securities entitled to cash flows from a specific pool of assets. So the general idea is, if we'll speak about mortgage-backed security, banks, investment banks, and other financial intermediaries, they simply batch together a pool that sometimes consists thousands and tens of thousands and sometimes even more of different mortgage loans. They batch them together. They know that they will get certain cash flows from those mortgages, some of them faster, some of them slower. But then once they know that when you put together thousands of mortgages together, then the cash flow is relatively smooth, although it can vary, and we will see the risks here. Then once they have a pretty stream cash flow, then those investment banks can sell it further on and can sell different cash flows to different investors later on. The majority of the market, and it is close to $3 trillion, it is a huge, huge market, consists of securities backed by residential mortgage loans. However, a large variety of other types of assets have been securitized, including commercial mortgage loans, car loans, credit card receivables, and all kinds of other things like that. The cash flow from the assets can be channeled to investors in two ways. One, they can simply pass through to investors, which means whatever the investment banks collects from the thousands of mortgage loans, the bank, for example, collects from the thousands of mortgage loans, they will simply pass it on to investors. Obviously, they will keep something to themselves, the administrative fees that are called also the service spread. And the second method is the cash flows can be allocated to investors according to specific rules. And we will see that different securities can build different tranches with different priority rules, that some investors that are assigned to a specific tranche will get the cash flow faster, and only then the money will be distributed to the second tranche and then the third tranche and so on. So there are different rules here of how to allocate those cash flows. But in general, the second method is called structured securities that have different rules to distribute the cash flow. Okay? Most of the time we'll speak about pass-through. The second method is a little bit too complex for us at this point, so I will mention it once every now and then, but most of the time we'll speak about a pass-through security. Most mortgage-backed securities and asset-backed securities share certain characteristics as follows. In almost all cases, payments, both those received from the pool of assets and those paid to security holders, are monthly. So most of the loans are paid monthly. Just think about mortgage loans, think about car loans, and this is also how they are distributed back to the investors. The monthly payments from the assets typically consist of principal and interest, while the principal can be scheduled or unscheduled. So we can design a specific date that the principal will be paid, or we can say that it will be paid sometimes into the future. The scheduled principal reflects the amortizing nature of most consumer loans, which means the principal is paid back gradually over the term of the loan rather than in one lump sum at maturity. Unscheduled payments of the principal, which are called prepayments, reflect the fact that most consumer loans can be paid off early, either in whole or in part. So most of you probably heard about the idea that whenever you take a mortgage from a bank, then it is possible, just in case you get a heritage or you win the lottery or you get a big bonus from your place of work, then you want to remove a big chunk of the mortgage earlier. So you can always do that. You can pay, and then obviously you will save money because then you won't have to pay the interest on the portion that you remove earlier, and this is called prepayment. So prepayment are obviously unexpected. The lender doesn't know that you will get a bonus from the bank and you will be able to pay back it. Sometimes you don't know it either. But in any event, the prepayments are unexpected and therefore they're unscheduled payments as opposed to scheduled payments. A little bit about how this market was developed. So in the US, government has played a key role in the development of the secondary mortgage market in the United States. It's called the secondary mortgage markets because the first market is obviously whenever people go to the bank and ask for a mortgage to buy a house, and then the securitization of those mortgage pools is called the secondary market. It is done through creation of 3 housing finance agencies, and the famous Ginnie Mae, Fannie Mae, and Freddie Mac. All 3 of them the headquarters are located very close to Washington, D.C. They are the institutions that they are not really government institutions, but they are highly correlated to the government. They were created by the government, for the government, and their executives are, in many cases, are people that retired or moved from different agencies that belong to the government, the U.S. government, and they form those 3 giants, the Ginnie Mae, Fannie Mae, and Freddie Mac. Basically, what they are doing is they're buying from the banks the mortgages. So banks are giving mortgage loans to consumers that would like to take a mortgage and buy a house, but they don't want to have all the exposures, so the banks are selling their mortgage to those giants that are called Ginnie Mae, Fannie Mae, and Freddie Mac. Those giants later on keep on securitizing them and keep on selling them to different investment banks and so on. Okay? A little bit more about the development of the market. So these agencies support the secondary mortgage markets by buying mortgage loans from lenders and ensuring that lenders have sufficient funds to make additional loans. The agencies can pay cash for mortgages and hold them as part of their portfolios, or issue the mortgage-backed securities in exchange for pools of mortgage from the lenders. Mortgage-backed securities provide lenders liquid assets that can be bought and sold in Wall Street or in any other market for that matter. And a little bit more, some corporations wish to issue securities with higher credit ratings than their own. This is called credit enhancement, okay? So for example, if you have an issuer, a company that is traded on the market, and their credit rating is, for example, BBB, and the company would like to boost some debt at a higher credit rating. what is called credit enhancement. Why all companies want to do that? Simply because whenever the credit rating moves up, then the yield or the yield to maturity that they need to pay on the debt is lower. And by that, companies can save money. So how can they do that? In many cases, companies issue special purpose vehicles, SPVs. Sometimes it is also called single purpose vehicle with the same synonym. So let's see what are special purpose vehicles. Special purpose vehicles, for example, can be different legal entities. It could be another corporation that is formed by the mother company. That is formed just to sell some debt securities, but it is backed by assets or receivables from the parent corporation. Why doesn't the corporation always seek a highest credit rating? Obviously, ideally, all corporations would like to get a AAA credit rating and pay very little yield and yield to maturity on their debt. But in fact, it just costs money. This credit enhancement technique, by creating a special purpose vehicle, by itself, it costs money. So there is here a trade-off between the cost of creating those special purpose vehicles, those special entities that are formed just to sell some debt, and the credit enhancement that eventually will save the parent company some money by issuing a debt with higher credit rating and lower yield to maturity. So altogether, what is a special purpose vehicle? It is formed as a special for one specific purpose, usually to issue some debt. It has very limited powers because it is a legal entity that is meant for one and only specific purpose. Okay, and that's about it.